Hello and welcome to Mastering Discounting, your ultimate guide. Today, we're diving deep into the concept of discounting, a fundamental element in finance that allows individuals and businesses to determine the present value of future cash flows. Discounting is the process of determining the present value of a sum of money to be received or paid in the future. This calculation is crucial because it allows us to account for the time value of money, which states that $1 today is worth more than $1 tomorrow due to its potential earning capacity. To understand discounting, we need to know about the discount rate. The discount rate is the interest rate used in determining the present value of future cash flows. It could be based on the cost of capital, the risk-free rate, or the required rate of return, depending on the context. Let's dive into a basic example. Suppose you are to receive $1,000 1 year from now. If the discount rate is 5%, the present value of that $1,000 today is calculated as follows. Plugging the numbers into our equation, the present value will be. So, $1,000 received 1 year from now, considering a 5% discount rate, is equivalent to $952.38 today. This process helps us compare cash flows received at different times on a like-for-like basis. Discounting becomes more complex with multiple cash flows over time, each discounted at the same or different rates. Let's explore this with another example. Imagine you have cash flows of $1,000, $1,500, and $2,000 to be received at the end of the next 3 years respectively. The discount rate is 5%. The present value, PV, of each cash flow is calculated individually and then summed up. The total present value, PV, of these cash flows is. In this way, we can see that the discounting process provides a clear perspective on the true value of future cash flows in today's terms. For a more detailed understanding, let's explore a more complex scenario where we need to handle an uneven discount rate over different periods. Consider the same cash flows of $1,000 in year 1, $1,500 in year 2, and $2,000 in year 3. But this time, the discount rates for each year are 4%, 5%, and 6% respectively. The present value of each cash flow must be calculated with its specific discount rate. The present value calculations for each year will be. Summing these present values, we get. Notice the difference due to the varying discount rates. Now, let's quiz your understanding with a few questions. Question 1. If you are expected to receive $2,000 in 2 years and the discount rate is 8%, what is the present value of this future cash flow? Answer. Using the formula PV equals $2,000 slash 1 plus 0.08 caret 2. We find the present value to be $1,711.57. Question 2. Calculate the present value of receiving $5,000 at the end of 5 years with a discount rate of 10%. Answer. Using the formula PV equals $5,000 slash 1 plus 0.10 caret 5. We find the present value to be $3,104.64. That wraps up our in-depth guide on discounting. Remember, mastering discounting techniques is key to making sound financial decisions in both personal finance and business investments.